Hey, it's David Ono with Worldwide Bookkeeping. Thanks for checking out another one of our videos. I want to thank everybody who's subscribed to our channel. It's been pretty cool to see the growth of that so far. We definitely love getting comments. We haven't been seeing as many of those lately, and at the time that I'm recording this, we've got about 10 more days or so for tax season. So if you got any other last second bookkeeping questions, feel free, weigh in on this video, any other video. Stay on topic, go off topic. We don't care. We want to answer your questions. We just want to help you with your bookkeeping. So anyway, thank you for watching. Please make sure to like this video, comment, subscribe, ring the bell, and let's get on with the video. Today, we're going to talk about the difference in bookkeeping for real estate investors, the difference between how you do your bookkeeping depending on your real estate investing strategy. It is different for if you're a rehabber or flipper versus being a landlord. Actually, let's just start with the common point of it. Anytime you go and buy a property, okay, it's going to be used for investment purposes. In QuickBooks, that's going to be added to your books in the form of an asset onto your balance sheet. Let's just say you buy a house for $100,000. Okay, that's the purchase price. That's going to be added on as an asset. That's the property added for $100,000. Now, there's some other adjustments that are going to go towards that. You get your closing statement at the end of that deal when you actually close on the property, and that's going to show, how much did you have to pay in like realtor commissions, if you got any kind of prorations, any rent money from that, or the seller gave you any prorated tax money, anything like that, any other kinds of closing costs that are involved with that. So those are things that can adjust that price. But just for example purposes, you buy the house for $100,000, it gets added on as an asset at $100,000. Now, the type of asset that it can be added as could be a little bit different. If you are a rehabber or flipper, if you intend to rehab this over the period of a few months, you're going to turn around and sell it in a few months. Well, that's a period of less than a year. So that would be called a current asset. So a current asset is anything you plan on using within 1 year or less. So that's one market difference there. If you're buying this with the intent that you're going to rent this out, for a long-term basis, and when I say long-term, you're going to hold on to the property long-term more than 1 year. Could be a short-term rental, an Airbnb, VRBO, something like that. You can still do that and call it a long-term asset. So I'm just talking about the period that you're going to hold it is going to be greater than 12 months. You would add that as a fixed asset. So you're going to add that. That's one difference there. If you're a landlord, it's going to be a fixed asset unless you're a rehabber and you have a long time horizon for a project. If you already know it's going to take 2 years to rehab this property, at that point, ask your CPA how you should be handling that process. But, okay, so let's go back to the flipper, the rehabber. If you are rehabbing the house, that gets added on as an asset. Now, when you go and do all of the repairs, and when we talk about repairs, I'm talking about the rehab of the house. So if you have to put a new roof on the house, you're replacing flooring, you're painting, you're doing plumbing, all those things. Those aren't actually called repair and maintenance expenses in the case of a rehabber. What you're doing is you are actually improving the property. So you bought the house for $100,000, but you're actually putting all of that money, the flooring, the roofing, painting, foundation work, any kind of work into that, it's all going into the actual asset itself. The capital improvements get added on to the balance of your asset. So as a flipper, as a rehabber, house flipper, your product that you sell is really the house, right? And so when you buy that original house and then you improve it, that's all going into that original asset there, and that's treated like your inventory, all of your houses and the improvements. Then when you sell the house, then that gets removed, and then the actual gain of the sale gets calculated as whatever's left over from the sales price minus all of your improvements, closing costs, the original purchase price and all that. And then that shows up as income on your income statement. I think what a lot of people end up doing, number one, a lot of times we miss even putting the asset onto the books. So if we go buy 123 Main Street for $100,000 and then we are doing a new roof and we got to get new siding, we got to get new windows. As those things come through QuickBooks, we start to see that's just added as a repair and maintenance on the profit and loss. And that is not actually correct if you're rehabbing. Now, if you're a landlord, that's a little different case. Okay, so we'll start from the beginning with a landlord. What you do is you're still going to, when you buy the property, you're still going to add that as an asset onto your balance sheet. And then before you actually rent the house out, if there are improvements that you need to make to get that to a rent-ready state where you're able to then turn around and rent it. If you have that work up front, it's going to be the same thing. That's going towards the capital improvements of the house. It's a little bit more of an area where you should probably confirm that with your CPA. But generally, you're not going to start expensing repairs until you actually have it rent ready. You get a tenant in there, you start to use it as an Airbnb, and you've got people coming in, on a regular basis. Then as you're doing repairs, that's ongoing regular repairs and maintenance that you can claim the expense for there. Of course, there are certain dollar thresholds. Everything's a little bit different, so it is kind of case by case. But if we're talking about you have a plumbing repair, that's going to be something that if you're already renting the house, you can just do that as a repair. If you're rehabbing the house, you have the plumber come in to fix a leak, that's going to go towards the capital improvement. It's not a repair. Now, the way that we account for these things as a landlord is different because, number one, we have the asset on the balance sheet, but then we also need, for every separate rental, we need to keep the income and expenses for each rental separate. And this is because the income and expense is going to get reported on what's called a Schedule E. Now, Schedule E is going to have a separate page for each individual property where you state how many days was this house rented out over the last year, how many days was it available for rent, the rental income that you earned, and then the various expenses. And they're split out by categories. So there are any kind of supplies, repairs and maintenance, mortgage interest, property taxes. There's a whole bunch of different things. You can look up a copy of a Schedule E. I'll see if I can link a blank Schedule E here so you can take a look at that. But so you want to keep that separate for each individual property. That way, at the time of doing taxes, it's a lot easier when you just have your books very neatly organized for property one. Here's all the income and expenses. Property two, here's all the income and expenses. Property three, income and expenses, so on. Instead of having everything mixed in together, you've done all your bookkeeping, but then you get to the end of the year and there's more work to do because you got to separate things out. And so that's where I see maybe the biggest kind of misstep for landlords who are trying to do their bookkeeping is they don't get these things separated out. Now, how can you separate this out? Best way, at least with QuickBooks Online, QuickBooks Desktop, is to use what's called class tracking. Okay, so you can set up a class for each individual property that you have. So property one, property two, and then you just apply that class label to any income or expense transaction that's coming through your bank feed. Okay, so I'm going to put a picture in here to show what class tracking looks like, how you can see the breakdown between properties, with their income and expenses. So I will put that in here. With rehab or wholesale properties, you're going to be tracking those just as assets over on the balance sheet for when you pick those up and when you're putting any kind of improvements to those. If you're a landlord, you're a buy and hold investor, you're going to add that property to your balance sheet as an asset, but then you're going to be treating your income and expenses once you get it rented out. Those are going to be profit and loss type categories. So anyway, thank you for watching this video. Make sure to like and subscribe. We definitely want to get more materials out here, more information out there in the community to help you with your QuickBooks. So if you have any questions about QuickBooks, any other kind of bookkeeping, real estate investing questions, also love to hear that. Thanks for watching. We'll see you on the next video. Okay, so here is the Schedule E form that I was referring to, where each individual rental property, you're going to record the address, the income, and all the expenses. So we can see right here in part one, it has list the physical address of each property, the city, street, city, state, zip code, and there's going to be all this other stuff: fair rental use, personal use days. Look, I'm not going to walk through how to fill this out. Your tax preparer will do it. But I'm going to show you why we actually go from separating these properties out by class. It's going to be a lot easier putting those things in the tax return. So number one, we'll see down here income for rents received. And so for the properties A, B, and C, and there will be other pages if you need. You have more than 3 properties, you can have multiple pages of these. But you got the income for your rents received, and then all the expense categories like advertising, auto and travel, cleaning and maintenance, etc. You can pull up a copy of this and look at it your own. Now, if you're brand new to QuickBooks or QuickBooks Online, you may want to just set up your expense categories to match almost identical to this list of expenses here, because these are the categories you're going to be putting all those things into on the tax form. Now, The only exception to that would be line 19 here. It says other. So you can attach additional schedules to this. So you can have additional categories. But basically, I mean, these lines 5 through 18, those expense categories, those may be the only ones that you need for your rental property. So you can check that out. So I just wanted to show you the form. Now, separating out by profit and loss by class. Just wanted to show you a concrete example of this. I've changed property addresses, the company name on here, but this is a real life company, real estate investors, and this is an example of a real profit and loss where you have, we can see in the far left column here, and I've exported this to Excel just to navigate a little bit easier, also so I can edit those fields out. But you can see we've got income, which is listed as tenant income. That would be the rental income. And then all of the expenses here. So we've got like alarm expenses for some properties, bank service charges, computer and internet, etc. You can just see those categories. There's not a ton of them. This is, this is a few more categories than what I showed you on the Schedule E, but it's not that out of line. It's going to be pretty straightforward for an accountant to do. So you can see like real estate taxes. Every single property here has real estate taxes, repairs and maintenance. Some of these properties had maintenance, some didn't. So there's going to be some deferred maintenance on those. But it's separated out by class, and you can see that with the property 1, property 2, property 3. Now you can name these classes whatever you want. If you want to name them like by the address or the street name, or if you have like a nickname for that, maybe some owners might have 1 duplex and maybe they have 1 single family, or this is my Kansas City property, or this is my Olathe, Kansas property. So you can have different names for those, whatever you want. I like the address because, again, that's something that goes directly to the Schedule E tax form there. So you can see with property 1, you've got your tenant income, your gross profit, and then all of these expenses below it here. So you got the depreciation expense, insurance, postage and delivery, real estate taxes, and there's your total expenses. You subtract your total expenses from your income, and that gives you your net operating income, your net income. It's pretty straightforward where you're going to be able to see like, hey, here's the bottom line for each individual property. How much money are we making by property? So it's not just the bottom line, but you also get the top line. When we say top line, we're talking about your gross profit here, and then you get to see all the expense categories. So you can see the properties by themselves. You can compare repairs and maintenance, right? So if you have multiple property managers, you can actually start to evaluate, hey, is this one property manager being a little loose with the repairs here? Are they like way higher than this other property manager? Are they doing more with less? So you can kind of check those things out, or any other expense categories. You kind of see like, hey, is this in line? Like I'm earning the same amount of rent on this place, on these 2 places, but this one property seems to have like repair costs way higher. And so you can kind of investigate like, why is that? Why do we have higher repair costs over there? Is it, is the tenant just calling all the time on there, or are we hiring contractors who aren't doing quality work, getting the job done right the first time? So we have to call them back to fix it, or call somebody new to fix it. So just kind of opens the door to see, hey, where are we doing well with each property? Where can we improve? But that's the whole idea of class tracking. Now, in terms of QuickBooks Online, that's going to require either QuickBooks Online Plus or QuickBooks Online Advanced subscription in order for you to get the ability to do class tracking. Now, you can kind of achieve this with tags. So if you're on Simple Start or Essentials, you could potentially create tags for each property, but there are some shortcomings to the tag system. Number 1, there's no ability to pop up a warning if you don't assign a tag to a transaction. So if you record a deposit for rent, and you meant to tag it with property 1, but you forgot to, it won't alert you that, hey, you didn't put a property on this. If you use class tracking, you can turn on the ability where if you forget to put a class, it'll say, whoa, you're about to record this. You didn't assign a class to it. Are you sure you want to do this? So it'll catch you if you're going to make that mistake. The other thing is there are certain transactions that do not allow you to apply tags or split them like a journal entry. So these may be things that your accountant needs to do anyway, but if you are using journal entries, you're not going to be able to split lines out by tag. So that is another potential shortcoming. An example of that would be if you go to Home Depot and you're buying materials, you're going to be doing some repairs on 2 different properties. Now you spend $500. $250 is going to go to property 1, $250 is going to go to property 2. You get up to the checkout line and you don't have your business credit card. Well, if you're going to use your personal credit card, you could record that with a journal entry into QuickBooks. But the problem is you'd be able to split that using classes, but you can't split it by tag. So that's a problem where you would then be scrambling. You couldn't really do the 250 to property 1, 250 to property 2. So it's going to lead to some imbalance in the accuracy per property. So class tracking to me is it's a must. I think if you are a real estate investor. So this went on a little bit longer than I thought. We will cut it off here.